All right, let's jump right into this explainer. We're looking at how you can actually put your idle cash to work without losing sleep over every single stock chart. We all know having your money work for you is basically the holy grail of building wealth. But honestly, staring at a sea of flashing red and green tickers is just overwhelming. So today, we're skipping all that stress. We're going to break down the investing world into a super clear, structured blueprint using hard data. Because look, instead of letting your hard-earned money sit in a bank earning literal pennies and quietly losing out to inflation, which hurts, we're going to explore 5 powerhouse Fidelity index funds. Now, these aren't just random speculative picks. They've been carefully selected based on growth potential, dividend yield, historical sector performance, and long-term stability. The difference between letting your cash sit idle and strategically allocating it into funds like these is, well, it's absolutely staggering. To make this real, let's follow a hypothetical investor. We'll call him John, and we'll see how his initial $100,000 investment could miraculously snowball into an extraordinary $20 million over 30 years. Yeah, $20 million. We aren't talking about small, incremental gains here. We're talking life-changing wealth accumulation, fueled entirely by the mathematical magic of compounding. So let's start the countdown with a solid defensive foundation and work our way up to the ultimate wealth-generating titan. Starting our countdown at number 5, we have the Defensive Core, FSTA, the Fidelity MSCI Consumer Staples Index ETF. This fund focuses entirely on the absolute backbone of the economy. Just think back to the devastating 2008 financial crash. While the broader market plummeted 38%, this sector held remarkably steady, falling only 15%. Why? Because it's heavily weighted in companies like Procter & Gamble, Costco, Walmart, and Coca-Cola. These are the essentials. No matter what the economy is doing, people are still buying toothpaste, groceries, and soap. You don't skip buying toilet paper just because the stock market is down. With over 98% of its assets securely in consumer defensive stocks, it offers an incredible safety net for your portfolio. Fast-forwarding through time, you can see how John's investment steadily compounds. Guided by an impressive 10.7% 10-year dividend compound annual growth rate, meaning the actual cash they pay you grows by that percentage every single year, his initial investment turns into over $2.3 million by year 30. And what's really wild for conservative investors is that by year 30, this fund would be generating over $165,000 in annual dividends. It's just a perfect, reliable mix of capital preservation and steady income. So the crucial point here is understanding the transition. You've got essential goods that protect your portfolio during a recession, like FTSA, and then you have the non-essential goods that absolutely supercharge it during a boom. Which brings us right to our next fund. Number 4, the Consumer Engine, FDIS, the Fidelity MSCI Consumer Discretionary Index ETF. Now notice the heavy concentration in massive industry innovators here. Almost 39% of the entire fund is made up of just 3 undeniable leaders: Amazon, Tesla, and Home Depot. This is the consumer discretionary sector. That means it thrives when consumers have disposable income to spend on luxury goods, leisure, online shopping, and entertainment. 96% of this fund is tied to these cyclical stocks, making it highly leveraged to explosive, rapid growth when economic times are good and wallets are wide open. Riding those consumer habits and strong historical sector performance, that original 100 grand explodes past $3 million over 30 years. And despite a lower initial dividend yield, the fund's 11.22% dividend growth rate means John would be generating nearly $20,000 in annual dividends by that 30th year. It's a really powerful engine for long-term wealth accumulation if you want to decisively tap into strong economic cycles. Coming in at number 3, the Healthcare Pillar, FHLC. The Fidelity MSCI Healthcare Index ETF. Similar to our defensive core from earlier, healthcare acts as an incredible anchor. During the 2008 crisis, FHLC suffered a much smaller drop of 22% compared to the S&P 500's massive 38% plunge. Honestly, healthcare is a pure play on stability because the demand for medical services remains totally consistent regardless of economic turbulence. People might put off buying a new TV, but they simply can't put off life-saving medication or critical surgeries. With heavyweights like Eli Lilly, United Health Group, and Johnson & Johnson making up over 25% of this fund, you get fantastic, enduring security. Powered by an impressive 16.8% dividend compound annual growth rate, John's healthcare investment nears $4 million at the 30-year mark. Now, that dividend growth rate is what you really want to pay attention to here. It proves the cash payouts have been snowballing significantly over time. For an income-focused investor wanting an ideal mix of defensive security and reliable upward growth, this is just a phenomenal pillar to hold. Moving on to number 2, riding the tech wave. 1Q, the Fidelity Nasdaq Composite Index ETF. This fund is a direct bet on human ingenuity and technological advancement. It tracks some of the absolute most innovative and fastest-growing companies out there. By focusing heavily on growth-oriented stocks, 1Q has historically outperformed a lot of other indices, posting a very strong 14.44% average annual return. It's heavily weighted toward those brilliant tech giants, giving you broad exposure to the hardware, software, and internet industries that are literally driving the entire modern economy forward. As we jump 30 years into the future, John's portfolio crosses the $6 million threshold thanks entirely to the disruptive power of this tech wave. We're really starting to see the sheer scale of what happens when you confidently allocate capital toward high-growth, innovation-focused sectors over long time horizons. Going from a modest $100,000 to over $6 million, this is where the math of compounding truly starts to feel like magic.
And finally, taking the absolute top spot at number 1, the ultimate tech titan, FTech, the Fidelity MSCI Information Technology Index ETF.
What's truly astonishing here is that nearly half of the entire fund's movement is driven by just 3 absolute titans of industry: Apple, Microsoft, and NVIDIA. If you believe in the transformative, world-altering power of technology, from personal software and global semiconductors to cloud computing and the whole artificial intelligence revolution, well, this fund captures that entire spectrum in one incredibly concentrated dose. Just look at these key performance stats. With 99.42% of its assets locked into information technology, this fund has achieved a massive 18.67% average annual return. But remember, it isn't just about capital gains. Think back to our compounding concept. Check out that staggering 19.08% 10-year dividend growth rate. This means these tech companies aren't just growing their stock price, they're successfully reinvesting their profits and returning massive, exponentially growing value directly back to shareholders year after year. This is where the sheer magnitude of compounding just shocks the system. Based on its historical average, that starting seed money achieves a staggering $20 million valuation by year 30. In just 20 years, it crosses $3.4 million. And then, in that last decade, the compound interest curve goes almost completely vertical. It adds nearly $17 million in value in just 10 years. It's insane. And the absolute cherry on top is the dividend payout. By year 30, John would be raking in over $126,000 annually, just from his FTech dividends alone. That translates to over $10,000 a month in pure, uninterrupted passive income, all while sitting comfortably on a $20 million nest egg. So, the crucial takeaway from seeing all this side by side is balance. As we review these 5 powerhouse funds, you can see exactly how building a well-rounded portfolio actually works. You need that defensive, recession-proof stability from staples and healthcare, paired with the aggressive, life-changing growth of the technology sectors. Blending these together can entirely transform your financial destiny over the long haul. Every single fund serves a distinct, powerful purpose and a long-term wealth strategy. The data we've explored today really speaks for itself. The difference between idle cash and invested capital is literally the difference between a stagnant savings account and a multi-million-dollar portfolio. So, the only question left for you is, are you ready to pick a strategy, let time run its course, and watch your wealth grow into the millions? Thanks for joining me for this explainer, and I hope this dive into index funds has empowered you to confidently take control of your financial future. Catch you next time.